In the previous video, I displayed the following chart. This is an allocation of my portfolio and I want to focus on two specific holdings, 3M and AT&T. 3M composed 6.3% and AT&T 7.1% of a 14K portfolio. Today, I want to say that I fully closed those two positions. Let's take a quick look. Starting with AT&T, I have 64 shares with an average cost of $21.49. The loss after selling was $495. For both companies, this value is without counting dividends. Now, the liquid value is the amount that will be going into my buying power. For AT&T, it will be $886. Looking at 3M, 8.7 shares with an average cost of $128.56. I sold for a loss of $230 and a liquid value of $885. The total amount added to my buying power is $1,772. Now let's take a look at the fundamentals of AT&T and why I had to sell this company. Over the last decade, the company has returned minus 46%, 10 years of losing capital value. That's horrible. When zooming out, we can see that the company is at a 2-decade low. The same value today is the same value as 1994. How can you justify that? How can you consider that this is a value play? Revenue seems to be increasing. The last drop is because of the spinoff, so this will be reflected in some charts. The net income has some inconsistency in some years, either dropping in value or going negative. The adjusted free cash flow looks similar to the net income. It seems to be trending up with some inconsistencies along the way. Now to the fun part, the dividend of AT&T was cut in half. Imagine losing half of your income from just one asset. Shares outstandings are increasing, meaning that as a shareholder, you're being diluted, therefore your position is worth less. The ROCE ranges between 5 to 8% in recent years, but when we look at the capital expenditure, it has gone up dramatically in the last 14 years. Despite AT&T bringing in some cash flow, we have to take a look at the massive debt they have. $128 billion in debt in a high interest environment. Compared to their cash flow, this is a lot of debt and a big red flag. This amount of debt is as big as the market cap of some companies. Management has stated that they're working on getting their debt down. So we have a capital-intensive business that need constant improvements to their services in an extremely competitive environment, no moat and piles of debt. For 3M, the story is a little different. Their fundamentals are on the slow growth side while minimum dividend increases to keep their record and small share buybacks. 3M has tons of pending lawsuits which currently have only taken effect in the share price of the company. 3M is better managed than AT&T, but the impact that the lawsuits could have on the weak fundamentals this company currently has could put a lot of downward pressure and even a possible dividend cut. I did a video on 3M explaining the fundamentals of the company. Make sure to check it out. So after selling both of the companies mentioned, I gained some buying power that I wanted to use immediately. I started a new position in Hershey, Pepsi, and Visa. These are high quality companies with predictable income. They are better managed than 3M and AT&T. By adding great businesses with healthy fundamentals and an excellent dividend growth, it takes the portfolio to a better level. 3M and AT&T were holding the portfolio down despite bringing in dividend payments. However, those payments were stagnating because they were not growing. With Hershey, Visa, and Pepsi, I expect the opposite. I expect increasing dividends, capital appreciation, more defensiveness, and a higher quality portfolio. I also added to my core holdings like SBUX and Kroger. As part of my 2023 goals, I stated that I want to high grade my portfolio, and with these transactions, I understand we're moving on the right path. That will be it for this video. Let me know in the comments section, what do you think of my movement? Do you still own 3M, AT&T, or any stock mentioned? I would like to see your thoughts. Thanks for watching, and I'll see you in the next one.